we have one side of the equation, assets. This you can say is operations, okay? This is all the stuff that the company uses to run its business. Okay? It needs cash to pay its employees and spend on whatever, all the stuff. It needs its vans, it needs its equipment. It needs all these assets or what it uses to actually deliver what it's trying to deliver. Okay? The other side of this equation is the finance side. Okay? So you can say the COO of a company, Chief Operating Officer, they are the chief of the assets. Okay? Their job is to ensure that the business is running well on the operations side. And all the assets are used efficiently, that they're all, there's no waste, whatever. The CFO is responsible for this side of the accounting equation. So what do we have? Liabilities plus equity. So what does that mean? Okay, let's just think about it in a very simple way. When you're buying a house, let's say the house costs $700,000. What is that? An asset, liability, or equity? The house itself. What do you think? It's an asset. Okay, so 700K. So how can you pay for a house? Is there only one way? What are the multiple ways? Cash. Okay. So that means, a liability, I guess we can borrow or we can come up with our own money, right? So if I go all cash, I'm not borrowing from nobody. And I'm contributing all the money myself, right? So this is balance. Okay. What's another way I can pay for a house? A loan. Okay. Is there some maximum or minimum amount? What's the maximum amount? I guess. Yeah, that's true. You could get a all 100% financed loan. Okay, this is rare. What's the typical way that this goes down? Yeah, like 80%. So it would be 70, 700K, and I don't know, 550. And then what is this called? Your contribution, down payment. Okay, so this is an example of a split between liabilities and your own equity. Okay, but in all cases, there's a balance to this. Okay, because all the assets have to be financed somehow, either through equity, and we're going to define equity in a little more detail. That's like the complicated one, or from borrowing. Okay, those are the only two options. Okay, and this, after every transaction, you're going to have a balance here. Okay, this balance for a business is going to exist at all moments in time. Okay, that's what this accounting equation is showing. The accounting equation is also showing you operations and finance. There's going to be a split in most companies between liabilities and equity, how that financing decision was made, right? A bank, the finance side of a bank is going to look very different than Google or Microsoft because their business models are different. The way they finance their assets are totally different. The assets are also going to be totally different. The assets of a bank versus Microsoft are totally different. Okay. So the entire business, the business model, what the business does is going to be captured in what the assets are and how they finance it. Okay. So everything we're going to kind of be doing now is going to be building on this equation. Okay. And really a lot of it is going to be in this equity because there's a lot going on in the equity section because as we know with the house, right? We have our down payment here. This is our down payment. What if I sell the house later for, let's say, 900K? Okay, so right now this is a house. I'm going to convert that house from a house to what when I sell it? No, but what's going to be in your bank account? cash, okay? I'm trading one asset, which is a house, for another asset, which is cash, okay? Now I have 900K. I've sold my house, I've made a profit. Let's say, whatever, I didn't pay off the loan right away, okay? I still owe this money, right? Agree? How do I get this to balance now? It's not balanced. What do I need to plug in for equity? Yeah, but just to give me the number. It's 350, right? 350K? 550 plus 350 is 900. We agree? Okay. So what is this 350 composed of? Well, of this 900K, I had originally put in 150, right? So I have 150K here. This is what I'm going to call, in the language we're going to be using, my contributed capital. This is money I took out of my out of my bank account and I put into this house. Okay? Contributed capital. I'm just going to short form it. Okay? And what else? What's the remainder? 200K. This is going to be what I've earned. Okay? In this case, my house appreciated. So this is like my earnings, owner's earnings. Okay? The bank did not participate in any of that. I own the house. I'm the one that benefited fully from that appreciation. Do we agree? Okay. This is the key difference between owning versus lending. Okay. The owner is going to benefit when things go good. They're also going to, if this house actually went down in value, let's say it went down to 600, 550, bank don't care. Okay. They're going to want their money. What's the, what's my equity now? 50K. So what happened here? I still have 150 I contributed to. This is my contributed capital, but I've lost 100. This is my loss. I ate this as the owner. Okay? So equity is only complicated because you have two of these different buckets. You have what you have contributed in money or whatever to the business as your contributed capital. And then the second part of it is the earnings.